Hey, what's up, my friend? So in today's video, you will learn how to avoid losses. Okay, because here's the thing, right? I know many of you get into trading and you face losses after losses, right? So today's video is for you if you keep getting stopped out of your trades only to see the market reverse back in your favor, or maybe you keep losing without knowing why, or maybe you have no idea what the heck you're doing, or maybe you just love watching my videos, then give me a thumbs up and subscribe to my YouTube channel, and this way you'll never miss an update again, right? Sounds good? Then let's get started. So the first technique that I want to share with you is this. Don't trade far away from an area of value. So what I mean by this is that in certain market conditions, especially when the market is trending in a healthy trend, the market tends to pull back towards the mean. Right? For example, what is the mean, right? The mean can be a moving average, a trend line, etc. So if the market respects a moving average, okay, you don't want to be entering when the price is far away from the moving average. That's because the market, when it's about to do a pullback, you probably get stopped out and boom, you get a loss. So let me share with you an example of what I mean by that. So look at this chart here. Okay, so let me just remove the lines and just pull out some moving average. So in this case, you can see that the 50 period moving average, right, for this 30-year treasury bond, the market tends to respect this moving average, right? Bounce once, twice, thrice. Okay, so the point I'm trying to make over here is that if you see a market respecting a certain moving average, okay, you don't want to be entering your trade when the price is far away from the moving average. So for example, if you look at this point in time, at this point, you don't want to be buying at this highs, right? You can see over here. You don't want to be buying at this highs. Reason being is that if the pullback occurs, right? Let's say if the pullback occurs, there's a good chance you will get stopped out of your trades unless you have your stops, right? A pretty wide stops, let's say below this swing low somewhere here. Then, hey, there's a good chance you will be able to hold on to the trade. But let me ask you, honestly, will you put your stops over here? Unlikely, right? Because I will see comments from traders, right, who say stuff like, man, Rayner, if you set your stops over here, it's too wide, you get a very poor risk-reward ratio, yada, yada, yada. And I agree. And that's why most traders, they won't put their stop loss over here. So that's why you don't want to be buying when the price is far away from the moving average, because more often than not, you will get stopped out on the pullback. Okay, so that's the first thing that I want to share with you. Okay. And also, when the price is far away from the area of value, the market is likely to do a pullback. So this is the first tip that I have for you, right? Don't trade when the price is far away from the area of value. And this can be moving average, trend line, etc. Number two, right? Don't chase breakouts. I know it's exciting, right? To chase breakouts, right? Man, Rayner, look at how bullish that candle is, right? Look at the strong momentum, right? It's time to buy. And when you do that again, right? Market is more likely, to do a pullback. And when you do a pullback, you will probably get stopped out as well. Because the reason is because when you chase breakouts, it is near difficult to find a logical place to set your stop loss. So let me give you an example of this. So let's talk about Bitcoin, right? This is a market that many traders, they chase, right, into the $20,000 price level, right? So let me just zoom out. You can see that over here, Bitcoin hit the highs of 20K before it reversed. And before it reversed, you look at the price action, how bullish this is. Right? Traders will be thinking, the market is going to the moon. I even see commentaries of Bitcoin hitting $100,000, right? Someone predicted 100K Bitcoin. And yeah, anyway, if you look at this, right, ask yourself, honestly, yes, it's bullish, right? But where are you going to set your stop loss? Where is a logical place to set your stop loss? And if you look at this chart, right, there is no logical place to set your stop loss unless you're willing to swallow a stop loss of this from this highs all the way down to, let's say, the previous swing low to about here, $5,000 to about almost $14,000. So your stop loss is about $9,000 on Bitcoin. Let me ask you, will you have a $9,000 stop loss on Bitcoin? Let me phrase it another way, right? For you to make a 1-to-1 risk-reward ratio on Bitcoin, the market has to move $9,000 in your favor. That's ridiculous. Okay, so this is why I said that you don't want to be chasing breakouts. Number one, there's no logical place to put a stop loss. And number two, more often than not, right, the market is about to do a pullback or consolidate. And when that happens, right, you will, again, likely get stopped out of your trades. Why is that? Because, again, ask yourself, right, touch your heart, ask yourself, where will you probably set a stop loss? Well, for most traders, they'll just, put some random stop loss on the chart, whatever their account justify. Maybe at this middle of this bars range, below the lows of this bars, below the low of this previous low of this bar. Yeah, so again, will the market care, right, where your stop loss is? No, right? It will reach back, right, the nearest market structure, like, like previous swing low or previous resistance turn support, that's where potential buying pressure would come in, right? It doesn't care, where you set your stop loss, and that's why, you get stopped out. All right, so this is one example, Bitcoin. Another one, it's, let me just share with you another one, right? How about this one, gold? Okay, so same thing, right? At this juncture, let me just zoom up the charts, all right? At this juncture again, you don't want to be buying at this highs. You don't want to be buying at this highs. You're chasing the markets, right? If you want to do it right, where is the logical place to set your stop loss, right? Couple of options. Number one is below this this swing low over here. Number two, this could be a previous resistance turn support, and if you set it somewhere below it, it could be somewhere here as well. So again, if you look at this chart, do you want to be chasing this market? This is not as bad as the Bitcoin one, but again, I would rather stay out of the trade because, again, if you don't set a logical stop loss, right, when the market does a pullback, when it consolidates, more often than not, you are going to get stopped out. Okay, so an example, in this case, the market simply chop sideways and consolidate. So you may or may not get stopped out. You can see that in this case, it did retest almost this previous highs over here, where it became a so-called previous resistance against support. So you can see that if you set your stops again, right, at random levels, right, below these lows here, or whatever your account feels like it, or whatever money is left in your account, you will probably get stopped out. Okay, so the second technique, right, that I want to share with you is, again, don't chase breakouts. And in fact, this is just a variation of the first technique I just shared with you. Okay, they are kind of similar but different. Same but different. Moving on, the third thing, don't trade into obstacles. What do I mean by this? So let's say you're bullish, you want to buy, right? So when you buy, let's say when you buy, right, you don't want to be buying right at this price level over here. Why you don't want to be buying here? Because there is an obstacle coming in your way, which is this area of resistance. If you buy over here, the market could possibly just go up a little bit in your favor and then boom, right, collapse back lower, back towards this area of support. Okay, so same thing for shorting, right? You don't want to be shorting right into support, right, because that's where potential buying pressure could be lurking, and if they come in, they step in, right, they're going to reverse the price against you, and you will again likely get stopped out. So be aware of this. Don't trade into obstacles. And let me share with you an example, right? How about dollar Mexican? Okay, so if you look at this over here, you can see that right now, okay, let me just get out my lines here. All right, see, these are the lines. You can see that right now, dollar Mexican, right, it's consolidating a little bit over here, right, this portion here. And do you want to be shorting over here? I hope not, right? Because if you look left, you notice that this is an area of support, right, around the $18.90 level. So this means, right, the market, right, if it does, let's say, break down below these lows, it could just trickle down lower a little bit before buying pressure could potentially come in and push the price up higher and possibly retesting back this previous support, now turn as resistance. So you want to open your eyes and see, where you're trading into. Don't trade into obstacles. Okay, this is important, right? So if you did apply this one technique, right, you realize that a lot of trades will be filtered away, because most of the time the price is just in no man's land, or it's near an obstacle and it's a trade that you want to skip altogether. So let me share with you another example. Dollar Canadian. Okay, so if you look at this again, same concept. So traders will look at this, right? Oh, Rayner, look at this bull flag pattern, right? Price goes up higher. There's a retracement, small bodied retracement, then price break and close above this swing high. Oh, the flag pattern is completed. Let's buy. And where are they buying into? Buying smack into this swing high, smack into this area of resistance. And that's where, right, potential selling pressure is lurking. You don't want to be buying into an obstacle. Okay, in this case, the market did reverse down lower from here. Okay, so let me explain, how you want to approach it. Instead, when you enter your trade, right, you want to enter from what I call an area of value. You want to enter, right, where there is potential movement, right, where the price could potentially move, right, that justifies the risk you're taking on your trade, otherwise known as risk-reward ratio. Okay, so in this case, let's say, hypothetically, okay, let's say this is a resistance, right? Let's say you went short somewhere here. Ask yourself, where is the nearest obstacle on this chart right now? If you ask me, right, the nearest obstacle is possibly at this area or level over here, at this point. So from your entry point to the first obstacle, there is enough meat in the move, right, to justify taking the trade. And these are the things that you want to look out for, right, whether there is enough meat in the move, right, to justify taking the trade. Okay, so this is what I mean by, don't trade into obstacles. And this is the third thing that I want to share with you. Avoid shorting into support, avoid buying into resistance. Now, The next technique that I want to share with you is called the boss technique. What is boss? Right, boss stands for break of structure. And in this approach, right, what you're doing is to look for confirmation, right, that let's say you want to buy, you want to look for confirmation that the buyers are in control before you establish a long position. Or if you want to short, right, you want to see that the sellers are in control before you establish a short position. So when you look at it, right, on the charts, it will look something like this. So let's say, market it's at, say it approached into this area of resistance. You don't want to be just selling at this area of resistance because you have no idea whether it might push out higher before it reverse, or maybe it might just break out of resistance altogether. So you want to look for confirmation, right, that the sellers are stepping in, right, before you take a short position. And one technique to share with you, right, is what I call the break of structure technique. So in this case, let's say earlier the price you saw it reach resistance, let's say it's on a daily time frame. So what you can do is go down to a lower time frame, like let's say the 2-hour time frame, and look for a break of market structure. So imagine this, right? Let's say this is the daily time frame. Right? Let's call it D. On the 2-hour time frame, it will look something like this, right? Market will be in an uptrend. Okay. And what I mean by look for a break of structure is that you want the market to show you a series of lower highs and lower lows before you take in the short position. So it can be in the form of like this, right? Price comes down lower, heads up higher, then break below this low. So at this point, you now have a lower high and lower low, telling you that, hey, the sellers are in control and about to, push the price lower. So this is one way to identify the strength or weakness in the market. This is what I call a break of structure technique. Another very common variations to it, right, is again classical chart patterns, right? For example, price comes up higher, then it forms a head and shoulders pattern, right? This is, again, I call this a variation of the break of structure technique. Or maybe it comes up higher, then it starts to consolidate, and then form lower highs into support, and then it breaks down. This is, again, another break of structure, right? You have, again, a lower high and lower low. Or maybe it comes up, right, from a double or triple top, then it form a build up at the lows. Again, in this case, it will be something like this. Then at the highs, they form a build up at these lows before it breaks down. Right, this again is what I call a break of structure. So there's a few variations to it, but if you understand price action, you will know all the different nuances, right, that could come along with it. So let me share with you a few examples of this break of structure technique. So first one, right, Aussie yen. So if you see over here, okay, at this point, right, market came into this area of a previous support and resistance. Again, you have no idea where the market is going to reverse. It could reverse before this resistance, it could reverse smack at resistance, it could reverse, right, after it pierces into resistance and then reverse from there. Anything is possible. So this is why, right, if you use the break of structure technique, right, you go down to the 2-hour time frame. Okay, I just zoom out a little bit, and you can see that over here, this is where the break of structure technique, right, comes into play. At this point, you can see that this is the resistance earlier you saw on the daily time frame. And on the 2-hour time frame, you can see that sellers, right, they are starting to come in, right, and taking control of the market. You notice that previously you have a series of higher highs and higher lows, but at this juncture, right, you now have a lower high, and this is the area of support, right, that is being guarded by the buyers. So when the price break below this area of support, right, you now have a break of structure. When it broke below this area of support, it breaks below here, you now have a lower high and lower low. Right, and this tells you that the sellers are now in control, and there's a good chance the market could continue lower from here. I'm not asking you to trade this particular pattern in isolation, right? I'm not asking you to trade descending triangle or head and shoulders pattern in isolation. What I'm sharing over here is just to look for confirmation, right, that the sellers are in control before you take a short trade. Because you've seen earlier on the higher time frame, the market is in a downtrend at an area of resistance, and what we are looking for is just sort of like an entry trigger, a confirmation, right, that it's time to enter the trade. Okay, so this is what I mean by the break of structure technique. And just one more example. Okay, let's say New Zealand dollar. Again, same thing. So if you just look over here, market at this point, right, retest back previous support, right, that could act as resistance. But here's the thing, right, if you trade live, right, you will always be wondering, man, will the market, retest this? Maybe it could do a retest of this previous swing high that could act as resistance. That could be possible. It could retest this previous support that could act as resistance. Or it could even go retrace deeper and retest this previous area of support that could act as resistance. So you can see that there is a lot of possibilities when you're trading in the live markets. You have just no idea at which exact level the market will reverse. So this is where, again, the break of structure technique comes into play. Again, go down to the 2-hour time frame. In this case, let me just zoom out, find the level quickly. You can see over here, the break of structure occurred at this point over here. Okay, so at this point, what you have is something like a triple, quadruple, quintuple top, right? You tested 5 times. 1, 2, 3, 4, 5. Okay, then this is the area of support. Price broke down, formed this somewhat of a bear flag looking pattern. And when it break below this swing low, now you have a break below this swing low, you have a break of structure. You have a lower low and lower high. Okay, so this tells you that there's a good chance the market could continue lower from there. And this is how you use the break of structure technique, right? To let the market show signs of strength or weakness, right? Before you enter a trade. And finally, right? To avoid losses, right? Don't put your stop loss at obvious levels, right? I don't know how many times I've come across, books, right, courses, right, forum, right, where, traders just put their stops below support or above resistance because that's what the textbook says, that's what the guru says. But the problem with putting your stops at obvious levels is that it gets hunted. It's very easy for it to get triggered before the market reverses back in your favor. Let me just share with you a few examples, okay? So if you look at this over here, pound dollar. Most of you actually know how to identify the trend, trade in the direction of the trend, but the way you set your stops, right, that needs a little bit of improvement. So if you look at pound dollar, okay, you can see that over here, market, right, it's bearish. Okay, let's say the market broke down this area of support, it's bearish, right, and maybe it forms somewhat of a pullback. Whatever the case is, I form a pullback over here. Traders went short on the break of this swing low, or maybe they went short on the break of this downward trend line. And where would they put their stop loss? Well, most traders, right, they will put their stop loss somewhere here. Or those, right, who are a little bit more knowledgeable, they set their stops above this swing high over here. And the problem, right, with setting your stops at this level is that it's very easy to get stopped out, because at this 3 price point, there is nothing, right, to stop the market from heading higher. Right, there is no swing high, there is no resistance. Yeah, there is resistance over here, right? But the problem with setting at this highs is that resistance is an area, not a specific price level on your chart. So again, when the pullback comes, you can see that market did a pullback, wiping up all the stops, right? Taking on the highs over here, so traders who set their stops above this highs also get stopped out as well, and only to reverse down lower. Okay, so if you're always getting stopped out and you see the market reverse back in your favor, it's probably because of this, right? So pay attention to this. So how should you handle this, right? So what I suggest is to give your stops, right, more breathing room, right? Set your stops away from market structure. So when you set your stop loss, you want to ask yourself, where is the market structure? And in this case, market structure is at this highs, this swing high, this resistance. And again, don't set it smack above this highs. Give it some breathing room, right? Give it some buffer. And one way you can do it is just to use the ATR indicator, such as ATR. Pull it out. I usually go with 20 period, but in this case the default is 14 period, but doesn't matter actually, right? I go 20 period, FYI. And what you want to do, right, is to find out what is the ATR value. So in this case, the ATR value is about 80 pips. So find out what is the highs over here, and you just add on 80 pips plus 80 pips. So if the highs is, let's say, X, right? So your stop loss will be X plus 80. That is your stop loss. And if you do that, right, you can see that even if the market spikes above the highs, right, your stops, right, should be away from it and you don't get stopped out prematurely. Okay, so one more example. New Zealand yen. Okay, same concept. So you can see over here, again, right, price pulls back, right, then it breaks down again. Where would traders set their stop loss? Again, probably above this highs, right, because that's what the textbook says, right? Set your stops above the highs, above resistance. In this case, right, you probably get stopped out, right, as the market tested the levels once, twice, and then reverse from here. So in this case, I'll be honest, right, even if you set your stops, right, 1 ATR from this highs, right, you will, I think in this case, we will still get stopped out. Okay, so it's not foolproof, right, but it should prevent, right, or avoid losses for you, right, especially if you have the tendency to just set it in the middle of nowhere or just above the highs or the lows. So this technique will help you. It's not foolproof. Nothing here is foolproof, right? Trading is all about probabilities, never certainties, and you gotta embrace it. So with that said, let's do a quick recap, right? Number one, you want to be trading near an area of value. Number two, don't chase breakouts, because when you chase breakouts, that's where the market is primed to do a reversal or a pullback. And also, right, there is no logical place for you to set your stop loss. Number three, don't trade into obstacles, don't buy into resistance, don't short into support. Number four, don't enter your trades too early. Okay, you can use a confirmation technique like the break of structure, the boss technique, right, to time your entry. And number 5, set your stops, right, away from market structure. Don't just set it below below support or above resistance, because it's very easy to get so-called hunted in this manner. Okay, so if you want to learn more about the work that I do, then just go down to my website, tradingwithrayner.com. The link is over here. You can see tradingwithrayner.com, and just scroll down a little bit, and I got a couple of trading guides for you. Depending what you want to learn, if you want to learn more about price action trading, support resistance, candlestick patterns, then just click this orange button, and I'll send this guide to your email for free. Or if you want to learn more about trend following, riding trends in the market, right, then download this ultimate trend following guide, right? Just click this orange button and I will send it to your email for free. Okay, so with that said, I have come towards the end of today's video and I will talk to you soon.